Do you ever wonder what secrets the financial elite are keeping from you? What if I told you there are investment opportunities so powerful, so resilient, that they can actually thrive when the economy takes a nosedive? We're not talking about your grandma's savings bonds here. We're talking about niche investments, carefully guarded by Wall Street's inner circle, that offer not just protection, but serious profit potential during a recession. Stick around, because by the end of this video, you'll understand why these investments are crucial for your financial future. And more importantly, how you can access them to recession-proof your portfolio and secure your wealth. This isn't just about surviving a downturn. It's about emerging stronger, wealthier, and more financially intelligent than ever before. If you're tired of feeling vulnerable to economic swings and ready to play the financial game like a true insider, then this is for you. For years, the mainstream financial media has peddled the same old advice: diversify with stocks and bonds, maybe a little real estate. And while diversification is certainly important, it often falls short when the entire market is in freefall. During a recession, correlation between asset classes tends to increase, meaning almost everything goes down together. That's why smart money looks beyond the obvious into specific, often overlooked sectors that exhibit countercyclical or non-correlated behavior. These aren't speculative plays. They're fundamentally sound, strategically positioned assets that address constant, often growing, needs, regardless of economic conditions. Think about it. When times are tough, what necessities do people always need? What services become even more critical? It's by identifying these resilient demand drivers that we uncover these hidden gems. Our first secret weapon in the fight against recessionary losses is distressed asset acquisition and management. Now, this might sound complex, but at its core, it's about buying valuable assets when their owners are forced to sell them at a discount. During an economic downturn, businesses fail, individuals face foreclosures, and otherwise solid assets become available at fire sale prices. This could be anything from commercial real estate burdened by debt, to intellectual property from a bankrupt tech company, to even entire small businesses that just need a capital injection and a turnaround strategy. The benefit here is clear. You're acquiring assets below their intrinsic value, often significantly so. As the economy recovers, these assets regain their true value, providing substantial capital appreciation. One common avenue for individuals to participate in distressed asset investing is through specialized funds or private equity vehicles that focus on this area. These funds pool capital from investors and deploy it to acquire, restructure, and eventually sell distressed properties or companies. For example, a fund might acquire a portfolio of non-performing mortgage loans, then work with borrowers to modify terms or, if necessary, foreclose and sell the properties at a profit. Another approach is through real estate investment trusts, or REITs, that specifically target properties in financial distress or those that have strong underlying value but are temporarily undervalued due to market conditions. The key is thorough due diligence and a clear strategy for value creation post-acquisition. This isn't about catching a falling knife. It's about understanding why something is distressed and having a plan to fix it. Imagine purchasing a prime office building at 60 cents on the dollar because the previous owner overleveraged, then refinancing it or finding new tenants when the market stabilizes. That's the power of this strategy. Our second niche investment, often overlooked by the retail investor, is digital infrastructure and data services. In today's world, data is the new oil, and the infrastructure that supports it is absolutely indispensable. Think about data centers, fiber optic networks, cell towers, and cloud computing services. These are the backbone of our modern economy, and their demand doesn't wane during a recession. In many cases, it accelerates. As businesses shift to remote work and consumers rely more heavily on digital entertainment and e-commerce, the need for robust, reliable digital infrastructure only grows. This sector is largely immune to cyclical economic pressures because connectivity and data storage are fundamental requirements for nearly every industry and individual. Even when belts are tightening, people aren't going to cut off their internet or stop using their phones. How do you invest in this? There are publicly traded companies that own and operate these assets, often structured as REITs, which means they pay out a significant portion of their earnings as dividends, providing a steady income stream even in turbulent times. Companies that specialize in data center operations, such as Equinix or Digital Realty, are essentially landlords for servers. leasing space and power to hyperscalers, corporations, and cloud providers. Cell tower companies like American Tower or Crown Castle benefit from the ever-increasing demand for mobile data and the rollout of 5G. Regardless of broader economic conditions, these are not flashy tech startups. These are utility-like businesses providing essential services with long-term contracts and high barriers to entry. Consider the massive investment required to build a modern data center or a nationwide fiber network. These aren't easily replicated, giving existing players a significant competitive moat. This means consistent, predictable revenue streams that are highly attractive during periods of economic uncertainty. Finally, let's talk about critical bioscience and medical technology. Healthcare, at its core, is inherently recession-proof. People will always get sick, they will always need treatments, surgeries, and innovative medical solutions. But within the vast healthcare sector, we're focusing on the truly critical, often life-saving advancements that cannot be delayed or deferred, even during economic hardship. This includes companies developing breakthrough therapies for chronic diseases, specialized medical devices used in essential surgical procedures, or diagnostic tools that are indispensable for patient care. These are not lifestyle drugs or elective cosmetic procedures. These are innovations that address fundamental human health needs. The regulatory hurdles and extensive R&D required for these products also create strong moats, protecting these companies from competition and ensuring pricing power. The opportunity here often lies in smaller, innovative biotech firms that are either nearing commercialization of a crucial drug or device, or larger medical technology companies with diversified portfolios of essential products. Think about companies producing insulin pumps for diabetics, pacemakers for heart patients, or advanced diagnostic imaging equipment. These are not luxury items. They are necessities. Even in a recession, hospitals continue to operate, insurance companies continue to pay, and patients continue to need care. Furthermore, demographic trends, particularly the aging global population, ensure a sustained and growing demand for these types of healthcare solutions for decades to come. Investing in this area means aligning yourself with fundamental human needs and cutting-edge science. Accessing these investments requires a slightly different approach than simply buying a broad market index fund. For distressed assets, you might explore private equity funds specializing in turnarounds or real estate workout strategies. These are often accessible through financial advisors who have connections to such opportunities, or directly for accredited investors. For digital infrastructure, look for publicly traded REITs that specifically focus on data centers, cell towers, or fiber optic networks. These offer liquidity and regular dividend payments. And for critical bioscience and medtech, focus on established companies with strong product pipelines and regulatory approvals. Or consider sector-specific ETFs that bundle these types of companies together. It's about careful research and selecting companies with solid fundamentals rather than chasing hype. The true power of these niche investments comes from their ability to offer diversification that truly works when you need it most. While your traditional stock and bond portfolio might be bleeding value during a recession, these assets can either hold steady, provide consistent income, or even appreciate. They are the defensive linemen of your financial portfolio, designed to protect your capital and even generate growth when the rest of the market is in retreat. Imagine the peace of mind knowing that while others are panicking, your investments are either stable or actively growing. This isn't just about making money. It's about financial resilience, about building a portfolio that can weather any storm. By strategically allocating a portion of your portfolio to these recession-proof niches, you are not only protecting your wealth, but also positioning yourself for significant gains when the economic tide turns. When others are selling low, you'll be holding assets that retain their value or that you acquired at a discount, ready to capitalize on the recovery. This proactive approach to investing is what separates the savvy investor from the herd. Don't wait for the next recession to hit. Start researching and building your resilient portfolio today. The financial landscape is always changing, but the principles of smart strategic investing remain constant. Be the investor who not only survives the next downturn but thrives in it. This is your opportunity to gain an edge, to understand the strategies that Wall Street insiders use, and to apply them to your own financial future.